Hello, hello, hello. Welcome. I am Beth. I haven't been here in a hot second. It's been a crazy, crazy first part of the year with the extended tax season, all of the COVID relief for payroll, for taxes, for all the things. And so I am back and I'm ready to get everybody updated. We are in the heat of the summer. Here in St. Louis, we're expecting record temperatures today, over 100 degrees. And I am just going to spend the day doing some recording some videos and coming here live and giving you some updates on the legislation and just staying cool in my AC. So welcome. For those who don't know me, I'm Beth. I am Beth Whitworth. I'm in St. Louis. I own a CPA firm that handles taxes, financial statements, bookkeeping, payroll, and we specialize in QuickBooks. I am also the owner of WLX Co., which is the arm of my business that is for education. And I have a membership called Accounting with Confidence, where I teach people how to be very confident in what they're doing inside their business, inside their QuickBooks software, whether it's desktop or online. And that is just my passion. So if you have any questions while I'm talking about a few things this week, go ahead and put them in the comments in Facebook. I should be able to see them. If you go up to the top of your screen where the comments are, you might have a choice to link to StreamYard. If you do that, then that will allow me to see your name and your profile picture so I know who's asking the question. So what I'm coming at you today with are some pieces of the tax legislation that actually weren't pertinent to the tax season. So we really didn't talk about them because there were so many things that happened in the December and the March tax legislation that had a direct impact on returns that were getting filed during the season. And so some of these things, we had to research, we had to learn, we had to wait for forms, we had to incorporate into your tax return. So, but there's other pieces that didn't happen. But before I talk about those things, I just wanted to give a little update on what's going on with the IRS. There are just so many stories of people who haven't gotten their refunds yet, who can't get a hold of the IRS, who wait on hold for hours and hours and then are disconnected. So, the IRS was affected by the pandemic just like everybody else. Their offices closed. Their employees became remote. Whether or not they had good systems in place to handle that, I don't really know. My experience over the last 25 years of the IRS is their systems are somewhat antiquated. I think that's probably putting it nicely. So they really had a struggle with a remote environment and being able to handle the volume of just a normal tax season. And then add to it the fact that we have had 3 or 4 major pieces of tax legislation, a change in the office, the main office in Washington, D.C., the change in the party. We've had so many changes that they really just, were not equipped to handle all of it. We've got, things that are relating to SBA loans, where people needed to get verification that tax returns were filed. That falls on the getting that information from the IRS. So they were just overwhelmed. Overwhelmed is putting it mildly. So what happened is, returns got filed very early in the season. Changes came that said, oh, some of those returns aren't right. We just changed the tax laws. We now are going to exempt some unemployment income. We're now going to not have you pay back some of your health care premiums. There were so many things impacting that then they kind of put a halt and they're like, okay, wait, how are we going to fix this? And so just between their systems being inundated and the rules changing, they're just behind. So they are still saying 10 weeks from the time you filed, especially if you filed during that weird shutdown period, which was kind of mid-March, where they were just like, we got a new rule and we also don't know how to deal with that. And okay, let's extend the tax season. So they are starting to get caught up, but it's very slow. And if for some reason you paper filed your return, just sit tight. Even when we weren't in a pandemic, even when we didn't have all the new legislation, paper filed returns it's like they get them in and they throw them in a box, and they'll get to them when they get to them, whether it's an amended return or you had to paper file because you had some fraud on your account and you couldn't e-file. Maybe you had to paper file because you had certain forms attached to your return. Those are sitting. So you can go to the IRS website and go, kind of check, where's my return. If it says it's processing, then they got it, especially if it's a paper return or an e-filed return. Then they got it, and you're just waiting. Do I think you should bother calling them? No, I honestly don't. I would say the earliest I would start calling relating to my 2020 return would be August. And even then, you might just want to wait. So just be patient. However, just, a heads up, the IRS is on a hiring spree. They are hiring. They had already had in place that they were planning on beefing up the agents they had in place, the revenue agents, all of the things to work through some auditing issues, and a lot of auditing had been put on hold. So supposedly they're going to beef up. They're hiring hundreds, if not a couple thousand people over the next couple of years. So is that going to make things go faster? Probably not. I mean, they've got some time that these people have to get trained up. Everybody doesn't walk in knowing how to handle things within the IRS. So it'll be a trickle down effect, but just be patient. What's really been odd is that some things have been just they've clicked through those things. The revenue tax credits, the ERTCs that were available for first quarter, if you applied with your first quarter 941, though some of those they went through like crazy, and then they put a halt. You know why? They're changing the forms. So second quarter, look for a new 941 form. So there's a change there. But back to what passed that is now coming up and people should know about, that doesn't affect your 2020 tax return. It actually affects your 2021, which we're sitting right here just about to the very middle of the year. The biggest thing that people will know and ask about is the increased child tax credit. So in the past, you were getting $2,000 per child under the age of 17, and that was not refundable until 2020. There was part of it was refundable, but only up to a certain amount. And so you could get $600 per kid. If you didn't have any tax liability over the $600, you didn't get that. Well, in 2020, they allowed you to get the other $1,400 to help stimulate the economy, get some money into the households. For 2021 and for 2021 only, they have increased the child tax credit from $2,000 for all children under 17 to $3,600 for children under 6 and $3,000 for children between 6 and 17. And they've made it refundable. And they've put in place a portion where you can get half of it in advance, meaning they're going to take so this is per child. So if you have, let's use an example. I have a nephew who has twin boys. They're 1 year old. Last year, they had a child tax credit available for $2,000 for each of those boys. This year, they're 1 year old. So they're still in that under 6 category. That means that they qualify for $3,600 per child in child tax credit that is refundable to them, that they can claim on their tax return. The IRS has come in and said, okay, let's prepay that. And the reason for that is to help these households, get back to work. So if you had some prepaid child tax credit, that could help put your children in daycare while you worked. That could help do some things to help your household since it, during this crazy economic time. So what they've said is, okay, we're going to give you half of that $3,600 per child up front starting in July, and we're going to give it to you monthly. And we're going to base it on your 2020 tax return. So based on the birthdays you listed on those tax returns, that will determine how much your child is eligible for. And it's either going to be $3,600 or $3,000. And if it's $3,600, you're going to get $1,800, $300 a month for 6 months in 2021 upfront. And we're going to deposit that into your bank account, or we're going to send you a check, depending on what was reported on your tax return. And letters are going out, and their letters are based on your 2020 tax return. So if you haven't filed your 2020 tax return yet and you have children, you want to try to get that in and done before July 15th, because that's when the payments are going to start. But letters started going out earlier this month stating that there will be, that you're going to be getting this money. And if you don't want to get the prepayment, it doesn't mean that you're never going to get the money. It means that you're leaving it all to be claimed on your 2021 tax return that you will file for, early next year. You have to log into this website and you have to opt out. Otherwise, half of the child tax credits are going to come to you automatically if you qualify. So what's going to happen here is my nephew, who has the 2 sons, will get $300 a month per child. So is that, let me see, 30, is that right? Or is that $600 a month let me do the math. Divided by 6, nope, 3,600 divided by 12. Okay. You guys, this is terrible. So $300, yes. So he's going to get $300 a month for 6 months per child. So he would get an extra $600 into his household. And then when he files his tax return, he's going to say, yep, I got this $600 a month, but I'm also entitled to this additional. The other half of it is going to be a deduction on his tax return and a credit on his tax return. And he can get that money back. So I don't think there's any harm in going ahead and just letting them send you the money, because one, the child tax credit is higher than it was in the past. It's not quite doubled, but for kids under 6, it went from $2,000 to $3,600, and it's only for 2021. So staying in this program does not mean that here comes January of 2022, you're not getting any more money. Right now it's a 2021 program only. So if you could get that money up front to use for your expenses as you go, as opposed to waiting for a big tax refund, I say do it. And my other philosophy on that is, if they're offering you the money and there's not consequences to you, I'd rather get it up front than wait for that refund. Things have happened. I want to say it was back in maybe 2013, 14, when all of the e-filing was starting to be required and the fraud was starting to happen, where people's essentially their social security numbers were compromised and people were filing tax returns in their social security number. Well, what happened there is, I had many clients who always banked on a giant refund. They were getting $2,000 and $3,000 and $4,000 and $5,000 back a year. And it was just a lump sum, and they just expected it every year. But what was happening was you were essentially giving an interest, you were investing in the IRS and getting nothing in return. However, in those years when the fraud started happening, those people who had their numbers compromised waited years to get those refunds. And so I had several clients that changed their tune and said, no, I need to break even with the IRS. I don't need to bank on some big refund in April to do some home improvements or go on vacation or pay off some student loan, or I need that money in my bank account every month, and let me decide how I'm going to spend it. And so it does take some discipline, but knowing that you have no control. Once that money gets to the IRS and they owe it to you, you're at their mercy of when you get it back. Go back to the beginning of this video, when I was saying the IRS is behind. You may or may not have gotten your refunds yet, depending on several factors. Did you mail it in? Did you put a bank account in, or are you waiting for a check? Did you get it filed during that weird blackout period that they kind of, I won't say they lost returns, but they did get caught in the system of the rules changed and now we have 2 different processings happening. So So the child tax credit, you're going to get a letter. If you, for some reason, don't want it, then you need to go into their website and opt out. Otherwise, July 15th, you're going to be looking for some money. So what happens if you didn't file 2020 yet, or you didn't have a filing requirement, but you do have dependents that qualify? You can go to the IRS website and you are going to take a look at essentially logging in and listing the information they need in order to get you that money up front. I believe that will trigger that you will probably need to file a tax return next year to true all that up, but I'm not sure. So if you have children that are joint custody, my suggestion to you is to opt out. If it's like an every other year type situation, it's going to get pretty ugly. So you really want to make sure that you know who's going to get the money for those qualifying children, because the child tax credit stays with the person claiming the child that year. So, and this is the child tax credit. This is not the child tax care credit, which is the credit that you get for paying for childcare while you're working. So if both parents are working, there's a amount of money you can get back for money that you paid to a daycare service or aftercare or those types of things. So the child tax credit, that's a big one. And we didn't talk about it, in the last 2 or 3 months because it affects 2021. And so now here we are, July 15th, you should start getting some payments. And look for that letter and hang on to that letter and put it with your tax information for next year. All of this stuff is going to be something new. There's going to be new lines. There's going to be new forms. There's going to be new blanks for all of us to fill in. There may or may not be some sort of reconciliation at the end of the year that they send to you that says you got X number of dollars. My guess is there won't be. But if there was, it would be a letter similar to what you got relating to the stimulus checks. So just be ready. I would say, like I said, just let it happen. If you qualified, your kids qualified, let it happen. If, you, for some reason, you don't think your kids are listed right, go to the IRS website, irs.gov, and put in the information to make sure that you get essentially on their roster before July 15th. So July 15th will be when it starts. It is supposed to be a monthly payment. You're not going to get it all up front. But until it starts happening, we don't really know how it's happening. So, but that's how it's been promoted, is that it's supposed to be monthly into your household, and then the rest of it taken on your 2021 return. All right. So here's another little weird thing that happened with the legislation. It was either December or March. I think it might have been the December legislation. And that is businesses typically, they have a meals deduction. So if you go have a business dinner, you go out to lunch with a colleague or a customer or whatever, you have a meals account and you put it in there. And at the end of the year, when you do your tax return, you're only allowed to take 50% deduction for that, because the IRS doesn't believe that you need to eat to have a conversation about your business. But they recognize that people do it. It's a way that people are, working inside their business. And so they give us 50%. For 2021 only, they put in place a method to help stimulate people going to restaurants and buying from restaurants. They are allowing 100% meal deduction for business meals, only for those at a restaurant. So, and it can be you, as long as you bought it from the restaurant, whether it's you DoorDashed or you Grubhub or all the things, you had it delivered, or you went there or you picked it up. As long as it's a restaurant, you get 100% deduction this year. And it doesn't qualify for things, you went to the grocery store. A lot of people will run to the grocery store and pick up food for the office lunch and, pre-made meals or whatever. Those don't qualify. It has to be a restaurant. It has to be somebody who's in the business of making and selling the food to be eaten on premises, even if you don't eat it on the premise. So my suggestion for businesses that do have a lot of meals this year is that you may be making a sub account in your meals account for the 100% or for the ones that aren't 100%. So that when you're putting meals through there or things where you're stopping at a convenience store and grabbing a soda, and believe me, these things happen. People, I see it run through business accounts all the time. Your salespeople are on the road. They stop, they get a cup of coffee at the convenience store while they're out. You're going to let them expense that. But that's a 50%. That's not 100%. A restaurant is the 100%. So, and it's only for 2021. So make sure that your tax preparer understands, and if you're a bookkeeper, that you can take 100% deduction for those things this year. Does that mean that those numbers should go up this year? Technically, no, but it should be higher than last year because last year the restaurants weren't even open. So it's a good way, to get that 100% deduction. For some people, it's sizable depending on the nature of their business. So make sure you're aware, make sure you are keeping those two types of meals separate so that you are getting an accurate deduction for your tax return. So that was another one. It's been for all year. So if you've already had some expenses, in January through today, those things are 100% deductible this year if you purchased from a restaurant. Gift cards to the restaurant, that's not really, that goes somewhere else. So it depends what you're using for it. You buying a gift card to a restaurant to give to a customer as a thank you, that's 100% deductible usually anyway, depending on the dollar limit. There is a 25% limit, or excuse me, a $25 limit, etc. So that's meals. Bonus, again, 2021 only right now. So the prepaid child tax credit, 2021 only, the meals, 2021 only. So the other piece I wanted to just circle back to, because there were significant changes last year, is relating to retirement accounts. So right at the end of 2019, some legislation passed that did a couple things. And one of the things it did was it moved the required minimum distribution requirement for IRAs from having to start at 70 and a half to starting at age 72. So that was a big change. It has been 70 and a half for as long as I can remember. The other thing that law put in place, again, it's the one that happened at the end of 2019 and then totally got forgotten about pretty much because COVID hit 2 or 3 months later, was that it eliminated the limit of when you hit 70 and a half, you had to stop. You were no longer allowed to contribute to your IRA. They removed that as well. So if you're 70 and a half, and I know people who are 70 and a half and still working, they're still making money and they still want to contribute to their retirement, they can now do that. They can keep putting in to IRAs. The other piece of that is they don't have to start taking out of their IRAs until they get to 72 instead of 70 and a half. And this is a lot of the nature of our aging workforce. People are not retiring at 60. They're not retiring at 65. Some are not retiring at 70. So as this is happening, they want to be able to put money aside for that retirement and then extend the time it takes before you have to start pulling it back out. So when you contribute to a traditional IRA, that money is taxable when you pull it out. And there is some philosophy change happening right now on, where are we right now? We're on some very low tax rates. We know the individual tax rates are going to be going up. We know it. It has to. We had so much funding last year and so much bailout of all the things that are happening relating to the pandemic. And then we also had a change in party. So that usually implies that there will be tax changes. And in this case, the taxes are expected to go up. So what's happening is people are thinking, well, it used to be I'm in a lower tax bracket when I retire. But now people are starting to contribute to their retirement accounts as very young, in their 20s, and they build up a lot, and then they have a very high required minimum distribution or monthly distribution that they have, and they're going to continue, and they're working later, they're going to, as they start to withdraw, you're still working at 72, you got to take that RMD. If you may be in a higher tax bracket, you may be paying more tax on it. So, there are some strategies that you want to talk with your financial planner about. If you're expecting that you're going to be a higher tax bracket when you retire than you are now, and just get that going, but know that the ages have changed. The other piece of the legislation that was affected by COVID last year was that there were no required minimum distributions for 2020, but that is back in place for 2021. So you do need to expect to take your required minimum distributions in 2021. That was it was a 2020 thing only. The other pieces of that is that if you did take money out of your retirement, regardless, like if you took it out early, say maybe you lost your job due to COVID, didn't have unemployment, didn't have enough unemployment, had to dip into your retirement, and you took some distributions to essentially keep you afloat due to the downturn from the economy and COVID, or being sick, or paying medical bills, or any of those things. There was no penalty if you were under 59 and a half. You typically get a 10% penalty. But for 2020, if you pulled out of retirement due to COVID, then there was no penalty. And there was also the opportunity to repay that money over 3 years. There was also the ability to spread the tax on that money over 3 years. So no penalty when you withdraw it. That was the first thing. If you're 59 and a half or under 59 and a half, you normally would have had a 10% penalty. For 2020, no penalty. You also only had to pay tax on a third of what you withdrew. For 2020, you could pay a third in 2021 and a third in 2022. Or you could go back and say, I got a job. I'm able to put this money back into my retirement. You have 3 years to get that money back into your account, and then it's not taxed to you at all. So recommendations there are, did you have a withdrawal? Check your return, make sure you didn't get penalized. Make sure you can support the fact that, yes, you had to withdraw that because of COVID. There's no documentation you have to provide, but you do have to essentially say, yes, it was due to COVID. And so many people, this happened to them. Some of it was they lost their job and they pulled out their retirement, or they quit their job because of the environment or whatever, or they had to stay home because their kids were home. There were lots of reasons. And all of those would qualify for that early withdrawal to avoid the penalty. But then also consider, you can put the money back or you can spread it out. If you didn't spread it out on your 2020 return, consider amending. Okay. Consider going back and amending. And, or, if you decide sometime this year or before you file next year's return that you are going to go back and put that money in, go back and amend your 2020 return. So definitely something to keep in mind, but RMDs are required this year. And if you take an early withdrawal, that no penalty has been removed. You would now be penalized in 2021. So just things to keep in mind relating to the retirement. So, all right, those were my updates. If you have any comments or questions, leave them here. I will follow up with you as soon as I can. It's great to be back. I'm excited to be not in the thick of a tax season right now, and being able to kind of go back and reflect on, okay, what information does everybody need to work on right now? What do they need to know? There's going to be some more legislation passed this year. There always is. Whether or not, I don't know, there's going to be a whole lot more relating to affecting 2021, but going forward, there will be. The EIDL targeted advances, they're still funding those. They're still following up with people who didn't apply. You have to be in a low income area. You have to have a 30% drop in revenues in a comparative period. They have still opened up the EIDL loans to get an increase. And so if you're in your SBA portal, you can apply for that. Again, some of those are getting a little delayed because they're waiting for the IRS to process the 4506T, which is the transcript. And they're having to re-verify, even if you provided it last year, because more returns have been filed, since then. Your 2020s have probably been filed, and they need to make sure no amendments have hit, so that they can make sure that nothing has changed and that you're really meeting those requirements that it is requiring. The PPP funds are pretty much done. There's still a little bit of stuff being funded here before the end of the month because the applications were already in process. If for your first round of PPP, if you received it in 2020, you should have been already working on that process of forgiveness or been wholly forgiven. If you got a second round sometime in this first or second quarter, you're going to be getting close to having used up those funds in an 8 to 24 week period, and that forgiveness application you'll want to get done. I would suggest sooner rather than later. One, get that off the books before tax time. That was one of those big things we were dealing with was, has your PPP loan been forgiven before the end of the year? And if it was, we treated it one way. If it wasn't, it was treated another way. If it was in process and considered to have been used properly, okay, maybe that's treated a different way. So don't forget about the PPP forgiveness. And then, some people got late on their first PPP. They didn't get it till April. So now they're just maybe getting in at the tail end of getting a second one in June. So you do have plenty of time, but make sure that you have it on your radar that those still have to be applied. The forgiveness has to be applied for. So don't forget. But anyway, that's it. That's all I'm going to talk about today. Stay tuned. I'm going to hop on some of these channels talking about what's been changing in QuickBooks very soon. It won't be this week, but probably next week. So everybody, I will see you next time and have a great day.